Whenever you mix faith and finance, there's always one big question that pops up. Are you sacrificing profits for principles? It's a really common assumption. But today, we're going to dig into the hard data behind Sharia-compliant finance and see if that idea actually holds up. So this gets us right to the heart of the debate, right? There's this widespread belief that any kind of constraint on investing, whether it's for ethical, environmental, or in this case, religious reasons, it just has to mean you're leaving money on the table. So let's just ask it straight up. Do the rules of Islamic finance force a choice between your faith and your financial performance? That's the core myth we're here to really look at today.
Well, it turns out the research on this gives a surprisingly clear answer. And honestly, it might not be what you'd expect. That whole idea of a necessary trade-off, yeah, it seems to be more myth than reality.
This phrase right here, pulled straight from the research, says it all. The returns are statistically indistinguishable from conventional banks. And that's not just an opinion, that's a hard statistical conclusion. It means any difference you might see is basically just random noise. So the takeaway here is crystal clear. When you get past all the assumptions and just look at the raw numbers, you find parity. These firms aren't just getting by, they're performing right alongside everyone else in the market. There's no built-in financial penalty for sticking to these principles. Okay, so that naturally brings up the next big question. How? If the performance is so similar, what's driving it? What are the specific things inside the Sharia-compliant model that are leading to these really solid financial results? The research points to this really powerful mix of three key things. First, you've got Islamic corporate social responsibility, which is all about the well-being of the community. Second is strong Islamic corporate governance, which makes sure management is held accountable. And third, there's a real focus on intellectual capital, the skills and knowledge inside the company. The study found that all three of these give a significant boost to financial performance.
And wow, this number really shows you the impact. In the banks that were studied, those three drivers we just talked about, they explained a staggering 94.56% of the difference in financial performance. To put that into perspective and financial modeling, getting that kind of explanatory power is practically unheard of. It's huge.
But, it's not some magic formula. There's a really important catch here. All those positive effects from those drivers can get completely wiped out if a bank has too much non-performing financing, basically a bunch of bad loans. It just goes to show that even though the model is strong, it's definitely not immune to poor risk management.
All right, so we've established that performance is comparable when times are good. But this is where the data gets really interesting, because the true test of any financial model isn't how it does on a sunny day, but how it holds up when a storm hits.
The global pandemic was this massive, real-world stress test for the entire financial system, right? And what the data showed was just remarkable. While pretty much all firms saw their profits take a hit, the drop for Sharia-compliant firms was way less severe. They showed this incredible level of resilience.
You can see it so clearly here on this chart. Sure, both types of firms felt the pain, but that drop in profitability for conventional firms was just so much steeper. The Sharia-compliant model really acted like a much better shock absorber.
And that resilience didn't just stop at profitability. The research also found that the firms that had flexible dividend strategies, meaning they could adjust what they paid out to shareholders during the crisis, they actually saw their stock prices bounce back earlier and faster. That kind of strategic flexibility paid off, literally. So when you put all this data together, what kind of picture does it paint? Well, it's a pretty distinct one. We're seeing that this is a lot more than just conventional finance with a few extra rules tacked on. Generally speaking, Shariah-compliant firms tend to be larger than average. They also show lower investment rates, and overall, they just display more conservative financial behavior. It's a profile that seems to prioritize stability and careful management over that aggressive, high-risk growth model.
So I think the ultimate takeaway here is that we really need to reframe the whole conversation. This isn't about choosing between ethics and profits. What the data is really showing us is a totally distinct financial model, one that's built on a foundation of conservative principles that just naturally leads to incredible resilience. And that leaves us with a pretty provocative final thought, doesn't it? In a global economy that feels more and more volatile and unpredictable, could a model that prioritizes stability, a model that shows this much strength during a crisis, could it be more than just a niche? Could this actually be pointing the way toward a more stable future for all of us?